putting pressure on the level playing field here.
You know, the argument, Joseph, from governments is that the incumbents that they bail out will continue to provide legs, you know, between destinations that maybe aren't as profitable as, or those legs that wouldn't be filled.
I'm placing a new order to sell short British pound at 130.97. New order, please. Short to sell at 130.97. All right.
The operation of that capacity. I think the real difference between us and the incumbent carriers is that we carry a passenger at the third of their cost, and simply they are unable to compete with us, and as a result they becoming.
New short position opened for British pound at 130.97.
Experience, and they don't want to be ripped off. And there are ways for governments to make sure that, you know, the country's interests or their political interests are fulfilled by procuring on a public basis. And we could be one of the contenders. As a matter of fact, we are doing it in Hungary.
Thanks very much, Joseph. Really good to speak to you. Joseph Varadi, the CEO of Wizz Air. 8:41, 8:42 here in London, 9:42 if you're in Paris or Berlin. Coming up, it's a positive session for European stocks this morning. The year of the day trader, perhaps, is upon us. We take a look at the surge in retail investments around the world next. This is Bloomberg. Welcome back to the European Market Open. 45 minutes into a positive session for European equity markets. We're off our highs of the session, but still up by almost 1% on the CAC 40 and not far off that on the DAX. It's 2020, the year of the day trader. Bloomberg Intelligence now estimates that retail investors are the second largest segment in US trading markets, with a 200% surge in trading volume year on year. Simone Foxman joins us now from Doha, and she's been looking at this story. Simone, good morning. This isn't just, though, about the US. There's some more global reference points here. How substantial is this surge of retail enthusiasm around the world?
Yeah, good morning. Well, for just an example, I take you to China, where we are seeing new brokerage accounts opened at the fastest pace since the stock bubble back in 2015. And if you look at July, there were 2.4 million new brokerage accounts opened, and we've seen a surge 6.5% this year. But honestly, I could tell you about this rise of retail investors in so many markets around the world. We could talk about India. We could talk about the UK, where Hargreaves, AJ Bell, both saying they've seen a lot of brand new accounts. We could talk about Schwab. We could talk about TD Ameritrade that also say they're seeing new accounts. And we could talk about the huge surge in Asia trading volume. This thought to be caused by retail investors, just indicative of how much of an effect they're having on the composition of the markets.
What do we know, Simone, about where the retail money is going?
Well, we know it's coming out of bank accounts. So look at Turkey. It's going out of accounts that are earning essentially negative real interest rates, and it's going into a couple of things. So Bloomberg Intelligence, in their assessment, did an analysis of the things that retail investors like. They like low profitability, they like high volatility, and they like cheap stocks. So you were talking with Paul Markham earlier, and he was bringing up all those concerns about the airlines. Well, those are an example of the low profitability names that Robinhood traders have gotten into. This is also behind some of the surge that we have seen in these smaller cap indices. US, China, and Japan are all good examples to look at that have really surged in comparison to the country benchmarks.
Thanks very much, Simone. Good to speak to you. Really interesting story, certainly one that's dominated a lot of the thinking stateside, but increasingly global, as you suggest. Let's take a look at some of the movers that are moving European equity markets then to the upside. We've got Aviva gaining after its takeover of Osisoft at an enterprise value of $5 billion. Danske Bank, an American judge has thrown out a lawsuit alleging the Scandinavian bank deliberately hid its involvement in money laundering, so that's having an impact. LVMH in the luxury space, Reuters is reporting that the deadline for the Tiffany deal is being extended by 3 months. So all of that adding to movement in those share prices. Matt?
All right, coming up next, from Brexit and gold to the EFO survey due in just under 10 minutes' time, we're going to talk about the factors moving markets with the Market Live team's Richard Jones. Next, this is Bloomberg. Welcome back to Bloomberg Markets. This is the European Open. We are 50 minutes into the session and looking at gains of 1% on the CAC 40, the FTSE 100 in London, up about 35 points to 6140. Let's take a look at what's moving markets across asset classes with Richard Jones. He's our MLive FX and rate strategist in Berlin. And Richard, you know, we are seeing gains in equity indexes, but the FTSE is really a huge laggard when you look across its global competitors. And you've got the furlough scheme about to end, as you're writing about on the MLive blog right now, plus Brexit coming up, and it doesn't look like they're making any headway there. Are we going to continue to see cable at 131?
Well, Matt, I think that the end of the UK government's furlough program and the bleak prospects for a Brexit deal are going to come together in the autumn to provide what I would describe as a really challenging backdrop for the economy and for the pound. I mean, we've got vanishing jobs and empty office spaces already damaging the country's recovery prospects. And I think that's currently weighing on consumer confidence. I think that's going to get much worse in the coming months. I mean, on Brexit, I think the messaging that we got last Friday from both sides was incredibly downbeat. You had both the EU and the UK blaming each other for a lack of progress in the negotiations. The EU concluding that that striking a deal on the future relationship seems unlikely. The UK said the EU's approach makes it unnecessarily difficult to make progress. To me, this points to the current transition period ending without a trade deal, and I don't think that's going to be good news for the pound. And then on unemployment, I think there's what I describe as palpable and very well-founded fears that unemployment is going to spike in the autumn when the government's current furlough program ends. It looks like Rishi Sunak is not keen to extend the plan that is currently protecting millions of jobs. So what I think this means is that when the program ends, the full extent of the pandemic's damage to employment in the UK is going to be a lot clearer. I think it could present a potential cliff edge for households in the UK. I think this and the lack of a Brexit deal is going to mean that the pound is going to fall considerably from current levels.
Good morning to you, Richard. And so the Brexit conversation and whether we get a trade deal is still relevant for UK assets, is it? Because so many other things, much bigger things, seem to be happening in the UK economy right now. But I suppose relative to other economies are also experiencing COVID-19, but they're not trying to renegotiate trade deals with their largest trading partner.
Yeah, I think you just hit the nail on the head there, Anna. I think that COVID is such a massive challenge for policymakers everywhere around the world. They've really got their plates full in trying to deal with the economic and public health impact of the pandemic. If you add renegotiating trade deals on top of this with your biggest trade partner and with others, I think it just becomes too big a problem. And I think in a relative sense, I mean, currency markets very much are relative valuations. And I think as a result, we'll see the pound suffer against other currencies because the public policy, the amount of public policy challenges that are facing the UK are really too much, will really be too much in the coming months.
I keep thinking back to Anna sent me a John Authors column this morning talking about the K-shaped recovery, and of course, that's kind of the hot word for economists right now, or the hot shape to talk about in terms of, you know, the inequality, a gain for some groups of people, some groups of stocks, some regions, and a loss for others. And the interesting thing I thought really was the outperformance of China. Of course, Authors is writing about the equity indexes, China versus other emerging markets and the rest of the world. But I wonder what it looks like from a rates and currency perspective. I mean, do you see that inequality there as well?
Well, I think one thing that we need to really get our heads around, and I think that PIMCO had made this point within the context of sort of a broader view on gold, is that the current lower for longer rates posture that we're seeing everywhere is something that we're probably going to have to get used to for at least the next 5 years, if not longer. I think real rates are at record lows. That's not going to change anytime soon. As a result, I think you're going to see different winners and losers across the globe. And I think that in the currency space, I think that if I look at what Europe is doing, I don't think they've dealt perfectly with the pandemic, but I think they've taken a slightly more proactive approach than what I've seen in the UK and the US. And so I think in the coming months, we'll probably see the euro continue to do well. It's well off the lows that we saw in March. I think it'll continue to do well against the dollar and the pound because I think the way public policy is approaching the pandemic is slightly more joined up than what we're seeing in the UK and the US.
Richard, thanks very much. Thanks for joining us. Richard Jones, our Markets Live FX and rate strategist in Berlin. Remember, you can get involved in our question of the day. Every day we pose one. Today was around sensitivity to COVID-19 and a vaccine. Reach out to us. Use the function IB plus TV Go on your Bloomberg. That'll get in touch with the TV and the Markets Live team. That's it for the European Open. Stay with Bloomberg Television. Up next is Surveillance. They will continue to follow the strength in these European equity markets for you. This is Bloomberg.
Committed to success, U.S. trade negotiators say both Washington and Beijing saw progress in talks. Equity markets continue to rise. Trump on the defensive. The president stands by his handling of the coronavirus on day one of the Republican National Convention. Nikki Haley says the Democrats are still blaming America first. A German slump. Europe's biggest economy shrank 9.7% in the second quarter. We'll talk the outlook for the recovery with the IFO Institute shortly. Welcome to Surveillance. I'm Yusuf Gameldine in Dubai. We've got hopes of progress on terms of a vaccine, and then at the same time signals that they're making progress when it comes to the U.S.-China trade tensions, and both of that really firmly supporting the risk rally we're seeing in a lot of these key asset metrics. Let me show you the state of play with the stock story in Europe at the moment. We're up 0.5%. It's a similar story in terms of the S&P 500 mini. We're coming off the back of record highs in U.S. stocks, but the good times might not last. According to Morgan Stanley, they're saying the market is vulnerable to shocks, especially rising rates, and the first tradable correction could begin imminently. Treasuries are on the back foot as we speak. We are looking at a week of greenback, halting a two-day gain. Your euro dollar is at 180.30. We are up 0.2%. And then gold is at $1,935 an ounce. Perhaps a little bit of, a strange one here, given the wider risk appetite here. But the folks at PIMCO saying that the gold rally isn't played out yet. And despite the recent run-up in gold prices, they believe gold remains attractively valued, especially in the context of low real interest rates. Let's get to the Bloomberg First Word News now for you. Here are some of the stories we are watching. Both the U.S. and China are seeing progress under their Phase 1 trade deal, and they're committed to the success of that. Senior officials from the two sides held discussions to review the 6-month-old agreement. The U.S. says they discussed steps China is taking, including greater protection for intellectual property. Beijing is still a long way off, though, in terms of meeting its promise to increase purchases of U.S. goods. New York is investigating if President Donald Trump's company falsely reported the value of his assets to secure loans and tax benefits. The probe was triggered by the president's former personal lawyer and fixer, Michael Cohen, who has fallen out with his ex-boss. He handed Congress a series of Trump's financial records from 2011 to 2013. No comment, though, from the White House. Chancellor Angela Merkel is demanding full transparency from the Kremlin over the case of the Putin critic Alexei Navalny. A German medical team has determined the Russian opposition politician was likely poisoned last week. The Berlin hospital says he is in a serious condition and may suffer long-term damage. Global news, 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Let's get you some breaking lines coming through from IFO then. The key line being the August German Business Confidence Index at 92.6. The market had penciled in 92.1, so a marginal beat then for the IFO August German Business Confidence line. Let's get straight to some additional context here. We are, of course, joined by some of the key voices leading some of the research. We had the German GDP on earlier. And we're now joined from Munich by the IFO Institute president, Clemens Fuest. Clemens, welcome back to the show. Based on the indicator we got from the German GDP figures just moments ago and now from your survey as well, is the recovery stalling, would you say?
I would say the recovery is more or less on track. So the GDP figures are slightly better than the ones we had a couple of weeks ago in the revision, and the climate index, the business climate index, continues to increase, to recover. This time, it's not just the expectation, it's really the current situation that's improving. We are still far from normal, but the recovery, I would say, is on track.
What about the labor market? Over the summer, tens of thousands of jobs have been cut. Is that going to continue?
Yes, I'm afraid we'll continue to see job cuts. We do see a lot of short-term work still going on. So a large part of the companies, it's roughly 40%, are still on short-term work. So we see that we aren't back to normal yet. But things are improving. So they're improving slowly, but they are improving.
You mentioned the short-term work, this concept of the Kurzarbeit. Are you an advocate for it? Does that need to get extended in your view?
I think it is a good instrument to deal with short-term crisis. Now, extending it would mean we extend something that would last until March next year anyway. So I think it's too early to extend it. It's a good instrument, but there is a danger that in areas where we need structural change, where we need people to move to different jobs, we prevent that structural change. So it's really a trade-off. And the longer we go on and the longer companies are on this Kurzarbeit, on this short-term work, the more likely it is they will have to change. So it's it can fix certain things, But I don't think we should have companies 1.5 or 2 years on the short-term work scheme.
From what you're seeing in the data, Clemens, should the ECB offer more stimulus as we go into the end of the year? And sort of what kind of measures would really help sustain, I mean, what is clearly still a very fragile, very nascent green shoots of an economic recovery? Let me put it that way.
I think we need to see that the German situation is better than the average situation in Europe. The European economy is suffering really from the difficulties with tourism, with travel. So it's a fragile situation. At the same time, I think it would be too early for the ECB to enact further stimulus. I think we should observe how the current measures work. And then see what's going on. There's a lot of stimulus in the economy. There is a lot of fiscal stimulus. I think what needs to happen now is the European recovery program. We need to get these projects going. That's more important than more monetary stimulus, in my view.
There's been a lot of back and forth in the press, Clemens, about whether or not the Schuldenbremse or basically the break on some of the debt regulations should be continued. Do you think that rule should stay suspended going into next year?
I'm afraid it has to remain suspended. There is no way in which we will return to a balanced budget in the at the federal level next year. So it will have to be suspended next year, and I'm not even sure we can get back to it in the year after that. At the same time, I think the signal is important that there is a strong commitment to fiscal solidity and consolidation in the medium term, but not now. There is no return to a balanced budget next year.
So as we look forward then, what should the priorities be for the government in terms of bringing together the right tools for a fiscal package to really sustain some of what you're talking about?
Again, a lot of fiscal stimulus has been decided. The challenge now is to make sure it really happens. So deciding fiscal stimulus programs is one thing, but really getting them to go is another. Getting public investment to be realized is a challenge because there are so many bureaucratic procedures. We have to make sure that these things really happen. There is a danger that the public investments that have, where we have the money ready now, that they happen in 2 or 3 years from now when the crisis is over. So I think at the moment it's more a question of implementation. The other thing is we need to make sure that we do not have to return to a general lockdown. We see infection numbers rising everywhere at the moment, and that is a challenge. It can be handled if we act decisively when there are local outbreaks. But what shouldn't happen is another general lockdown. We need to avoid that.
I mean, one of the tools that have been implemented is the suspension of some of the insolvency filings. That may make a lot of sense in terms of trying to fast-track some of the bureaucracy. But at the end of the day, you also run the risk of creating zombie companies, not just a few, but a lot of them. Is that something you're beginning to think about as well?
Absolutely, that's a tricky question. So I think it was right to suspend this because we don't want courts and other institutions to be overburdened with insolvencies. At the same time, there is a danger that they get overburdened once we get back to the old rules. So I think it's now time to think about new.
I'm placing a stop on profit for British pound at 130.95. Stop on profit at 130.95.
Process more efficient and quicker.
Clemens, really appreciate your insights there. That's Clemens Fuest. He's the EFO president, of course, with some additional perspective on the latest news. Now, coming up, progress. U.S.-China negotiators discuss the Phase 1 trade deal as Washington says both sides are committed to its success. We're going to break that down next. This is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, and politics. This is Bloomberg Surveillance. I'm Yusuf Gameneddin in Dubai. Let's get you up to speed then with the Bloomberg Business Flash headlines, starting off with the biggest reshuffle for the Dow Jones Industrial Average in 7 years. ExxonMobil, Pfizer, and Raytheon are out, and they're making way for Salesforce, Amgen, and Honeywell. The new companies will enter the gauge next week, and it's a stunning fall from grace for Exxon, especially. That's the world's, or was the world's biggest company as recently as 2011. TikTok has asked a federal judge to block the White House from enacting a ban on the video app. President Donald Trump says TikTok is a security risk for user data, but the company says the president's decision was made for political reasons and is unconstitutional, violated rights as well to due process. Virgin Atlantic is set to find out if it has enough support from creditors for a £1.2 billion rescue. It's already won the backing of 3 other creditor classes and now has to convince suppliers. If they vote against the plan, the airline can take it to a judge to overrule them. That's the Bloomberg Business Flash. Let's circle back then to one of our top stories. Senior U.S. and Chinese officials have held a routine call, and they say that they're satisfied with progress under their Phase 1 trade deal. The USTR says they address steps China has taken to ensure protection for international and intellectual property rights, eliminate forced tech transfers, and remove barriers to U.S. companies in finance and agriculture. The two sides say they are committed to the success of the deal. Let's get out to Julian Chillingworth. He is the CIO at Rathbones, and he joins us now. Julian, I mean, initially then the market taking this very positively. To what extent were you surprised that they were able to make progress, not just this fast, but at such a, well, testing time, especially given that U.S. elections are just around the corner?
Good morning to you. Yes, indeed. I mean, it's positive news that they held the meeting because, as you may recall, less than 10 days ago, the meeting was postponed. So that's good news, and that they are making progress. But we should also bear in mind that, if my memory serves me correctly from some stats I saw, that as of the end of June, the Chinese had only completed 23% of the amount of U.S. goods that they said they were going to buy this year. So there's a lot of work still to be done, and I think it will be great to see some fresh orders coming through. I'm sure Donald Trump will be delighted to see some purchases of agricultural products, for instance. So let's see whether talks today then move on to actual buying of U.S. goods, and also giving U.S. companies, which was talked about today in this meeting, access into Chinese markets more openly.
There's been a very heated debate around the market breadth in the S&P 500. And, Julian, I want you to weigh in on this for me, because 59% of the S&P 500 members are trading above their 200-day moving average. And the last time we had this was in late 1999 to early 2000. It was right before the internet bubble burst. Your research underscores that there are still significant risks that remain. What is going to derail the momentum that we're seeing?
Well, I think that I don't know whether you got a simple PE chart or even a cash flow analysis chart that you could look at the tech sector, but obviously you saw massive overvaluation in the tech sector as we ran into the bursting of the TMT bubble. And I would suggest to you that we're nowhere near that now when you look at the PEs on the tech sector. Yes, they're high, but we're in a much lower rate environment, in a low growth environment as well, even if recovering from COVID-19 quite quickly in this quarter. So it's a very different environment. You've got companies making good profits, generating good cash flow, and I think they will sustain their higher ratings. What obviously will derail some of the bubble-like valuations we've got is if they don't deliver. These companies can't produce profits in the near term or next 12 to 18 months and are just rated on a function of sales or even not even sales. So it's the ones that have been inflated and dragged along by this momentum we're more worried about, not the larger companies that are producing profits.
Right.
And also I would say to you that I don't think, unless
you're very optimistic about a strong bounce in the economy, you're going to see the value names come to the fore anytime soon.
Sure. Julian, again, it's a question of trying to mitigate risks, and the rally that we are seeing in these assets is a cross-border rally for the most part, and Credit Suisse really underscores the pain that a lot of portfolio managers and sort of fund managers are having to deal with, because bonds no longer work to diversify stock risk. So how do you go about that?
Well, I think you obviously, first of all, you're absolutely right that that yields have fallen back, and there's little, shall we say, short-term mileage in the bond market as far as we're concerned. Although I would always emphasize that we say to our clients that you need elements of government securities, government bonds in your portfolio, to give some access to easy liquidity and a degree of diversity, it's not going to be the driver for gains and alpha in your portfolio. That is going to be through equities, and we continue to believe that. In terms of diversity, I mean, obviously, people have been buying gold. Now, this is all about the debate of whether you do or don't believe in gold as a diversifier, and also whether you do or don't believe that we're going to see some measure of inflation a year or so down the line, which will be helpful for gold. So, I mean, I think there are ways to diversify. The other ways, obviously, are looking at alternatives. Infrastructure has been cited as an interesting play, particularly with government stimulus. So there are other elements that you can look at within your portfolio to give some diversification.
Julian, hold that thought. We still have a lot to talk about. That's Julian Chillingworth. He is, of course, the CIO at Rathbones. Well, up next, the German economy shrank 9.7% in the second quarter. We're going to get deeper into the data from the euro area's biggest economy. That's next. And also, of course, the calls from Julian Chillingworth. This is Bloomberg. You're watching Bloomberg Surveillance. I'm Yusuf Gameneddin in Dubai. Well, we have some breaking lines hitting Bloomberg from the key voice, of course, in the German cabinet, Mr. Scholz. He's speaking at a news conference in Vienna, and he's saying that there are signs that the German economy is developing better than expected. It comes after the back of news and data that we got that German companies and consumers cut spending sharply during the virus-related restrictions. The German economy contracted 9.7% in the second quarter. Initial estimates for 10.1%, that's what they had been penciled in for. The numbers, of course, show the scale of the slump at the height of the lockdown restrictions in the euro area's biggest economy. Let's get back out to Julian Chillingworth from Rathbone. Julian, your initial reaction then on these figures?
I think it's good to see a slight improvement on the first estimate that we saw, but not a surprising number at 9.7. And I think, it's all about how quickly the German economy bounces back in Q3. The flash PMI numbers we had on Friday, I think, were slightly disappointing for the euro area more generally, and there may be concerns that the bounce back in Q3 won't be quite as strong as some people had been estimating. So we'll just have to see how that fares, and obviously with a pickup in the new virus cases across Europe, and concerns about localized lockdowns, that's obviously going to hit growth across the region more generally. But in Germany, I think they're doing all the right things. Angela Merkel's handled the COVID-19 crisis well to date, and I would hope to see a reasonable bounce back in Q3. But obviously, we need to wait till the end of the quarter to see how that pans out.
So where's the opportunity then in Europe at the moment? If it's not going to be so much Germany, because in your research you highlight that sterling's already pricing in a lot of very negative scenarios, and at the same time UK stocks are trading quite a notable discount compared to some of their global peers.
Yeah, they are, and I mean it's also partly due to the makeup of the UK market. Obviously, a heavy energy component along with materials has an effect, and obviously quite a heavy domestic consumer weighting as well. But I think where the UK is concerned, obviously it's all about now how quickly we see the UK economy recover. The leisure sector is making some positive signs. Help out, eat out to help out has been positive, and I think we could see perhaps a surprising Q3 in the bounce in the UK economy.
Julian, thank you very much. A little bit squeezed for time there. That's Julian Chillingworth, the CIO at Rathbone. We're going to get into the U.S. elections next. This is Bloomberg.
another day of risk off across the financial markets, we bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, and politics. This is Bloomberg Surveillance. I'm Yusuf Gameneddin in Dubai. Let's get to the Bloomberg First Word News again. Here are the stories we're watching. The U.S. Food and Drug Administration is walking back its claims over an experimental plasma therapy. On Sunday, the agency's commissioner said it provided dramatic benefits and could save a huge number of lives. But last night, the FDA was forced to clarify its numbers. There are promising signs for the treatment, but the benefits aren't yet fully known. Wisconsin's governor has deployed the National Guard after police shot a black man in the city of Kenosha, south of Milwaukee, on Sunday. Troops are being tasked with guarding infrastructure and protecting firefighters. But the ACLU has criticized the move, calling it militarized policing. After hitting the Caribbean, Tropical Storm Laura is poised to become a powerful hurricane. It's due to make landfall on the U.S. Gulf Coast on Thursday. An alert has been issued already in parts of Texas and Louisiana. Another storm, Marco, has lost so much of its power, it's weakened to a tropical depression. Global news 24 hours a day, on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. That's the News Belt update. Let's get then to the story around the Republican Party in more detail, because they formally nominated President Donald Trump for a second term. Trump has sought to paint a positive picture of his handling of the coronavirus pandemic. More broadly, a procession of speakers, including members of his own family, have set out to counter the Democrats' portrayal of Trump as incompetent and to depict his opponents as radicals.
These are the incredible workers that helped us so much with the COVID. We can call it many different things, from China virus. I don't want to go through all the names because some people may get insulted, but that's the way it is.
Biden's radical left-wing policies would stop our economic recovery cold. He's already talking about shutting the country down again. It's madness.
The economy is on the ballot. Law and order is on the ballot. Our most cherished ideals of freedom and free markets are on the ballot.
So when it comes to what Joe Biden says he'll do, look at his actions. Look at his policies. Look at what he already did and what he didn't do.
The intelligence community recently assessed that the Chinese Communist Party favors Biden. They know he'll weaken us both economically and on a world stage.
Joe Biden and the Democrats are still blaming America first. Donald Trump has always put America first, and he has earned 4 more years as president.
Joining us on the phone is Bloomberg's Kathleen Hunter now for the latest. So what exactly is the Republican strategy here ahead of the election? What's crystallized?
Well, I think that what we're seeing here from the Republicans is kind of the counterpoint to what we saw from the Democrats last week, painting a very scary and negative picture of what the country is going to look like after 4 years of Joe Biden. Last week, what we heard from the Democrats was a similarly negative picture of what the country would look like after 4 more years under President Trump. And so I think that in some ways that's not surprising, but it seems like in some ways, the Republicans are trying to make this a referendum on Joe Biden's vision for America. And generally, that's not how these elections work. Generally, these elections are referendums on the sitting president. And so I think it's a harder sell for the Republicans to sort of paint this scary picture of what the country is going to look like with Biden as president, given what's happening now with the economy and the coronavirus, but that's certainly going to be their strategy, I think, going forward.
What do we know exactly about the content of the call on the phase one deal, and how significant is that really in the broader portfolio?
Well, I think so. There was this call about, phase one of the China trade deal, and I think that it sounds like all signs coming out of that were pretty positive in terms of both sides, the U.S. and China, wanting to continue to make progress towards a trade deal and really more significantly being committed to the deal that was already made. And so I think that is certainly significant. I would expect Trump and his allies to continue to talk about that type of progress with China. But of course, this all has to happen within the context of, the broader deteriorating U.S.-China relationship and the fact that, Trump is at this time, it's a bit of a difficult needle for him to thread, given that he's trying to, on one hand, tout the progress he's made with China, but on the other hand, paint China as a villain. We heard it in one of the clips you just played. He's calling it the China virus. He's talking about, there's increasing signs from everything from TikTok and WeChat to, the relationship with Hong Kong. The U.S.-China relationship is really deteriorating. And I think that, pointing to this sort of small-scale, small-bore trade deal may not really counteract that all that much.
Kathleen, thank you very much. Great catching up. That's Bloomberg's Kathleen Hunter there. Let's get some more context on what the election means for emerging markets. Joining us now is Luis Costa. He's the head of CEMEA FX strategy at Citigroup Global Markets. I mean, Luis, for emerging markets, a lot of this is going to come down to the valuation of the dollar, isn't it? And, given that we already have local outflows at the time of a weaker greenback, it's not necessarily going to be straightforward sailing, is it?
That's right. And to be honest with you, the markets have already absorbed a lot of this dollar bearishness, and they were right. The one derivative in terms of broad dollar dynamics from central banks boost in the balance sheet is the case of the Fed, is the case of the other DM central banks, is dollar weakness. And that's exactly what we are having now. So, I mean, there are other derivatives as well. For example, the bids to gold. I mean, it's not about risk aversion. It's about, a big boost in central bank liquidity and what does it do to precious metals. So this is all part of the cycle here. So the dollar is definitely giving a very nice gift to some EM currencies out there, even though we remain quite skeptical of, massive performance on the MFX side.
There's a lot of debt that's being issued in emerging markets, in developed markets. Ultimately, that's going to start weighing on U.S. 10-year yields. And it's a very, very heated debate. So I'm not going to weigh in on that on a personal note. But from the people that we've spoken to, there is upside risk here. Is that the next front that you'd be watching?
That's exactly our point. Upside risk, in terms of yields, right? We, especially on the EM European side, on the CEMEA side, we've been very worried in a way of the implications of the vaccine trade. We are in a moment where term structures in many parts of the EM world, in the EM world as well, they are so flat and they're so low. And here we are, in an environment where 4 or 5 possible vaccine solutions to come afloat over the next, couple of quarters. So I believe this is present and immediate danger to term structures out there. So we don't want to be received rates in many low yielding curves in EM now. We actually believe this is a time for steepeners and payers in some of these curves.
Luis, I was looking at the world currency ranker on the Bloomberg, and year-to-date total return on some of these emerging market currencies might be a few surprises here for some of our clients. And we put this up on a graphic. The Egyptian pound and the Argentine peso leading those gains with sort of double digit, about 10% for the Egyptian pound. You remain positive on the Egyptian pound. Is that on the local currency duration play? Is that how you would go about this?
Yeah, that's exactly it. I think that Egypt still has a very interesting development story in terms of trying to reshuffle the fiscal side despite the COVID crisis, of course, and the fact that monetary policy has been very transparent in a way even better than some of the major EMs out there. in an environment where we don't feel a shock, an imminent shock on the inflation side. So the development in terms of flow has been a positive development in terms of clients getting more exposure to the fixed income, the local fixed income side, which is obviously positive for the currency. So we do like, we are very skeptical in terms of frontier in general now, but we do like Egypt if compared to other major plays in the EM liquids.
Let's circle back to the positive news around the hopes of a vaccine breakthrough and some progress in these trade negotiations between the U.S. and China. Is the primary beneficiary going to be within the EMFX space, the Asia complex? Is that what we need to be watching out for?
Well, I think that's, our positive view on EM Asia goes through various channels, right? It's the fact that if you look into China, and there was one host talking about China maybe 10 minutes ago with you, and China, if you look into the macro barometer of China now, it's screaming for renminbi appreciation. And that's exactly what we're seeing now. In an environment where, I alluded to my previous comments, in an environment of relatively weak dollar dynamics or broad dollar dynamics. We are seeing, there's a fiscal impulse coming out of China. You're seeing some better developers on residential and building, the building sector. So this is all coming to grips here, and it probably tells you that renminbi, there will be further renminbi appreciation. And this is very important for the EM FX Asia complex. It helps a lot the low yielders over there as well, the Koreas of the world, the Taiwans of the world. So we believe that, dollar Asia now, or Asia FX, is in a much better zip code if compared to LATAM and CEMEA.
We saw what happened in Turkey. The idiosyncratic risks are very real, but in many ways, if you look at the broader emerging market space, you could make the argument that they're not being priced in sufficiently. If you had to pick one country that fits that description, which one would it be?
It's a difficult one. To be honest with you, we've been switching gears quite a lot to the credit worthiness of South Africa. And I do believe, even though we are invested in South Africa in other parts of the curve, we do believe that the credit worthiness side is very important. One of the big derivatives of this COVID crisis is a big boost in the fiscal worries, right? And South Africa was already struggling quite a lot on the fiscal side, and this is now only augmenting fears and concerns of fiscal imbalance going forward. So we've been very focused on the credit worthiness side of South Africa if compared to other EM majors.
Louis, I've really enjoyed this chat. A lot of insights there. Thank you for that. That's Louis Costa. He's the head of CEMEA FX strategy at Citigroup Global Markets. Coming up, has the Fed created the speculative bubble? Well, Omega Family Office Chairman and CEO Leon Cooperman thinks so. We have more from that conversation next. Worth staying around for. This is Bloomberg. Economics, finance, and politics. This is Bloomberg Surveillance. I'm Yusuf Gameneddin in Dubai. Well, let's take a look at some of today's key events that we've marked out on the agenda. Chinese Foreign Minister Wang Yi starts a tour across Europe. He will be visiting Italy and then the Netherlands, Norway, France, and then on top of all of that, it's going to be Germany as well. The trip comes ahead of a key summit between President Xi and some EU leaders in mid-September. Richard Branson's Virgin Atlantic, in the meantime, told a London court that it will run out of cash in September unless it secures a $1.6 billion rescue package. And today, the airline is going to be convening creditor meetings to vote on the restructuring. And then this afternoon, watch out for U.S. data at 3 p.m. UK time when we will get the figures for new home sales for July. And then you also have the consumer confidence for August. Well, while the Fed's response to the pandemic helped stabilize the markets, low interest rates are creating a speculative bubble. There's no argument around that. That's according to Leon Cooperman. The Omega Family Office chairman and CEO spoke with Bloomberg about how exactly zero rates and mounting national debt are impacting the U.S. economy. Take a listen.
They have created a real speculative bubble, in my opinion. I have to admit that I'm uncomfortable at the present time not because of the virus. It's a factor. I'm uncomfortable because I'm focused on something the market isn't focused on, and that is the amount of debt that's being created. Who pays for the party when the party is over? You know, we just celebrated our 244th birthday, and basically it took us 244 years to go from zero national debt to 21 trillion. We'll probably end this year at 27 trillion. That is a growth rate in debt far in excess of what the economy is growing at. And I think that that's going to be a problem down the road.
Yeah, well,
and I think they've created a real speculative environment. You know, I was just looking, to give you some statistics. Apple announced their 4-for-1 split on July 30th. The 20-day average call volume at that time was 721,000 calls. Okay, this past Friday, Apple traded 2.1 million calls, 3 times the average of 20 days. Okay, and the stock is up 17% since the announcement of the split, and that's before this morning. Tesla announced their 5-for-1 split August 11th. Same thing, big increase in call volume. The stock is up 49% since the stock split was announced, against the S&P up 1.9%. Now, the last time I checked, if somebody gave me 5 singles for a $5 bill, it didn't create any wealth.
Right.
Okay?
Well,
it did not create any wealth.
That was the old calculation. Now this is the new calculation when you've got a big component of Robinhood investors. That's sort of one theory out there. What's riskier right now, the high-flying stocks or bonds?
Well, I think no question that bonds, to me, present a return-free risk. And that's what's working in favor of the stock market. What I've not fully appreciated is what a zero interest rate environment does for stocks. I was focused on the fact that we've had zero interest rates in Japan and Europe, and their stocks are 5 or 6 multiple points below the United States market. So I think low interest rates are indicative of a problem economy. You know, we've had artificial support for the economy since 2008. You know, it's 13 years. And I don't look at that as being a positive. I look at that as possibly being a negative. You're Stephen Ratner, close to Mike Bloomberg, who I have enormous respect for, basically wrote an article this morning in the Times op-ed piece, the economic recovery that isn't. You know, I think that the zero interest rates is creating a very speculative tone to the market. I have said for months now that we're really dealing with 3 markets, not one market. The first market is the FANG market. And frankly, these are very fine companies, these technology companies whose demand has been pulled forward by at least 5 years due to the virus. They're not cheap, but by the historical standards of the Nifty 50 of 1972 and the technology bubble of 2000, they're not in any way expensive. And people could conjure up whatever they want to conjure up.
Into the world of Stephen Ratner, you look.
Position closed on British pound at 130.95.
Cooperman theory, given the distortions that we have now, can you stay with original investment science, or do you have to invent something new for the next 10 years?
Look, I'm 77 years of age. I have no clients. I retired at the end of 2018. and I do what makes me comfortable. Right now, I have very, very, very few bonds. I think bonds represent a return-free risk. And I own, I was beginning to explain to you, there's three markets out there. There's the FANG market, richly appraised, but not ridiculously appraised, okay?
Yeah.
Then the Robinhood market, which is ridiculous, totally ridiculous. Regrettably, I said this on TV about a month ago, that market would end in tears, and the very next day, some young man who lost $70,000 day trading committed suicide. Okay, Carl Icahn is as bright as they come. He liquidates his position, Hertz, at 72 cents a share, and 3 weeks later is trading at $5. And you check into what's going on, it's on the Robinhood platform. Eastman Kodak, Robinhood platform. Tesla, Robinhood platform. So,